Many industries can be intimidating to newcomers, as a flurry of acronyms are tossed around when people first dive in. Unfortunately, the investment property loan space can sometimes be guilty of this. Here are some helpful definitions to illuminate commonly used terms to know when looking for loans on your real estate investment properties. Real estate investing acronyms to know. ARV, after repair value. After repair value is the value that is estimated for a property after planned renovations are done. It is typically done at the beginning of the renovation project, such as when doing the fix or flip or BRRRR method strategies by a hard money lender, and determines how much will be lent. DSCR, debt service coverage ratio. This is the ratio of the revenue from the property divided by the expenses associated with the property. A DSCR ratio of 1 means that the property is breaking even, or revenue equals expenses. A DSCR ratio greater than 1 means that the property is cash flowing, whereas a DSCR ratio less than 1 means that property is losing money every month. Note, for DSCR loans, the DSCR ratio is calculated as rent divided by PITIA, while DSCR ratios for commercial real estate loans is typically calculated as net operating income divided by debt service. ARM, adjustable rate mortgage. This is a mortgage loan in which the rate is not fixed throughout the entire term. Many rental property loans, particularly DSCR loans that are ARMs, are better described as a hybrid fixed to ARM structure, where the rate is not floating throughout the entire term. Rather, it is fixed for an initial period, typically 5 or 7 years, before then floating on a designated schedule. Typically, DSCR ARM loans are described with 2 numbers in the shorthand, such as 5-1. The first number refers to the initial fixed rate period, and the second number refers to the frequency that the rate adjusts, in this case every 1 year after the first 5 years of the term. Loan to cost. This ratio measures the loan amount compared to the cost of purchase and any renovations done to the property. Note that it is distinct from loan to value, which represent the ratio of the loan amount to the value of the property. One of the foundational cornerstones to building wealth in real estate is that the end value of the property is greater than the cost put in. So rather doing the BRRRR method or fixing and flipping, the goal should be to have the LTC higher than the LTV. LTV, loan to value. This is a key metric in rental property loans, comparing the loan amounts to the value of the mortgage property. MTR, medium-term rental or mid-term rental. This refers to investment properties that offer stays for greater than 30 days but less than full-year leases. Typically, these are aimed at traveling nurses, families displaced from a home renovation, or academic professionals, and have 30 to 60-day stays. These fall in between short-term rentals and long-term rentals. PITIA, Principal, Interest, Taxes, Insurance plus HOA. This acronym is for the standard monthly payment on DSCR loans. The principal and interest part represent the debt service payment to the lender, while taxes and insurance and HOH dues, if applicable, represent payments on important expenses that are often collected and escrowed by the lenders. The taxes and PITIA refers to the property taxes, while insurance refers to property insurance and flood insurance if applicable. PUD, Planned Unit Development. This refers to a property that is generally a standalone home but part of a community, typically with an HOA and monthly dues. PUDs may also have usage rules that does not apply to single-family homes. RTL, Residential Transition Loans. This is a term typically for hard money loans used for renovations and rehab of properties, transition from distress to stabilized. This term is typically used in more financial and securitization circles, but referred to as hard money or bridge loans among investors. STRs, short-term rentals. This is becoming the standard terms for short-stay investment properties, generally offered for stays less than 30 days, but typically for week-long stays or less. While a lot of investors use STRs interchangeably with Airbnb, many real estate investors have transitioned to preferring the STR term to better encompass a strategy, particularly as people operate their properties on multiple platforms. Bonus. SFR, single-family rentals or single-family residence. This has become a confusing term in real estate lending. If the popular SFR term means a single-family residence or a single-family rental, while they seem the same at first glance, there is a pretty strong distinction in that the rental implies a non-owner occupied property, whereas a single-family residence can include any housing stock that is one unit. It's important to note this distinction when dealing with lenders. Was this helpful? Make sure to subscribe to our channels, like this video, and if you'd like to learn more or have another acronym you're confused on, feel free to comment below.